Hello friends, today we will learn more about the subject working capital management. This subject introduces working capital management or short-term financial management, which is concerned with decisions relating to current assets and current liabilities. The key difference between long-term financial management and working capital management is in terms of timing of cash. While long-term financial decisions like buying capital equipment or issuing debentures involve cash flows over an extended period of time, like 5 to 15 years or even more, short-term financial decisions typically involve cash flows within a year or within the operating cycle of the firm. There are two concepts of working capital: gross working capital and net working capital. Gross working capital is the total of all current assets. The constituents of current assets include inventories, that is raw materials and components, work in process, finished goods and others, trade debtors, loans and advances, cash balances, bank balances, and so on. The constituents of current assets are a major aspect of working capital. Net working capital is the difference between current assets and current liabilities. The current liabilities include sundry creditors, trade advances, borrowings of short term, that may be from commercial banks or others, provisions, and so on. Management of working capital refers to the management of current assets as well as current liabilities. The major thrust of this is, of course, on the management of current assets. This is understandable because current liabilities arise in the context of current assets. Working capital is a significant facet of financial management. Its importance stems from two reasons. Investment in current assets represent a substantial portion of total investment. Investment in current assets and level of current liabilities have to be geared quickly to the changes in sales. To be sure, fixed asset investment and long-term financing are also responsive to variations in sales. However, this relationship is important and is not as close and direct as it is in the case of working capital components. The importance of working capital management is reflected in the fact that financial managers spend a great deal of time in managing current assets and current liabilities, arranging short-term financing, negotiating favorable credit terms, controlling the movement of cash, administering accounts receivable, monitoring the investment in inventories, and investing short-term surpluses consume a great deal of time of financial managers. While managing working capital, we have to bear in mind two characteristics of current assets. First is the short lifespan. Second is the swift transformation into other asset forms. Current assets have a short lifespan. Cash balances may be held idle for a week or two. Accounts receivable may have a lifespan of 30 days to 90 days, and inventories may be held for 1 day to 60 days. The lifespan of current assets depends upon the time required in the activities of procurement, production, sales, and collection, and the degree of synchronization among them. Each current asset is swiftly transformed into other asset forms. That may be cash is used for acquiring raw materials. Raw materials are transformed into finished goods. This transformation may involve several stages of work in process. Which finally ideally reaches finished goods, generally sold on credit, and are converted into accounts receivable, which is a book debt, and finally accounts receivable on realization generate cash. The short lifespan of working capital components and their swift transformation from one form into another has certain implications. That is, decisions relating to working capital management are repetitive and frequent. The difference between short-term or may involve the difference between profit and present value is insignificant. The close interaction among working capital components implies efficient management of one component cannot be undertaken without simultaneous consideration of other components. For example, if the firm has a large accumulation of finished goods, inventory, it may have to provide more liberal credit terms or show laxity in credit collection. That is, if the firm has a liquidity crunch, it may have to offer generous discounts. The working capital needs of a firm are influenced by numerous factors. The important ones are nature of business, seasonality of operations, production policy, market conditions, conditions of supply. Discussing each of these major factors. Firstly, nature of business. The working capital requirement of a firm are closely related to the nature of its business. A service firm like an electricity undertaking or a transport corporation which has a short operating cycle and which sells predominantly on cash basis has modest working capital requirements. On the other hand, a manufacturing concern like a machine tools unit which has a long operating cycle and which sells largely on credit has very substantial working capital requirements. Seasonality of operations. Firms which have marked seasonality in their operations usually have highly fluctuating working capital requirements. To illustrate it better, consider a firm manufacturing ceiling fans. The sale of ceiling fans reaches a peak during the summer months and drops sharply during the winter period. The working capital requirements of such a firm are likely to increase considerably in summer months and decrease significantly during the winter period. On the other hand, a firm manufacturing a product like lamps, which have fairly even sales around the year, tends to have stable working capital requirements. In case of production policy, a firm marked by pronounced seasonal fluctuations in its sales may pursue a production policy which may reduce the sharp variations in working capital requirements. For example, a manufacturer of ceiling fans may maintain a steady production throughout the year, rather than intensifying the production activity during the peak business season. Such a production policy may dampen the fluctuations in working capital requirements. Market conditions. The degree of competition prevailing in the market has an important bearing on working capital needs. When competition is keen, a larger inventory of finished goods is required to promptly serve customers who may not be inclined to wait because other manufacturers are ready to meet their needs. Further, generous credit terms may have to be offered to attract customers in a highly competitive market, which ultimately makes working capital requirements tend to be high because of greater investment in finished goods inventory and account receivable. If the market is strong and competition is weak, a firm can manage with a smaller inventory of finished goods because customers can be served with some delay. Further, in such a situation, the firm can insist on cash payment and avoid lockup of funds in accounts receivable It can even ask for advance payment, partial or total. Conditions of supply. The inventory of raw materials, spares and stores depends on the condition of supply. If the supply is prompt and adequate, the firm can manage with small inventory. However, if the supply is unpredictable and scant, then the firm, to ensure continuity of production, would have to acquire stocks as and when they are available and carry larger inventory on an average. A similar policy may have to be followed when the raw material is available on seasonally and production operations are carried out round the year. Talking about the kinds of working capital, with the need of the business, the kind of working capital can be classified on the basis of the periodicity and the concept. An important working capital policy decision is concerned with the level of investment in current assets. Under a flexible policy, also referred to as conservative policy, the investment in current assets is high. This means that the firm maintains a huge balance of cash and marketable securities that carries large amount of inventories and grants generous terms of credit to customers, which leads to a high level of debtors. Under a restrictive policies, also referred to as aggressive policy, the investment in current assets is low. This means that the firm keeps a balance of cash and marketable securities, manages with small amounts of inventories and other stiff terms of credit, which leads to a low level of debtors. On the basis of periodicity, further working capital can be addressed as permanent working capital and variable working capital. What are the consequences of flexible and restrictive policies of working capital? Very broadly, a flexible policy results in few production stoppages, that is on account of inventory storages, ensures quick deliveries to customers, and stimulates sales because liberal credit is granted to customers. Of course, these benefits come at the cost of higher investment in current assets. A restrictive current assets policy, on the other hand, may lead to frequent production stoppage, delayed delivery to customers, and loss of sales. These are the costs that the firm may have to bear to keep its investment in current assets low. Determining the optimal level of current assets involves a trade-off between costs and the rise with current assets and cost that falls with current assets. The former are referred to as carrying costs and the latter as shortage costs. Carrying costs are mainly in terms of the cost of financing a higher level of current assets. Shortage costs are mainly in the form of disruptions in production schedule. Loss of sales and loss of customers are the main form of disruption in cost of working capital. The optimum level of current assets is denoted by CA as the total cost. The sum of carrying costs and shortages are minimized at that level. Often the total cost curve is fairly flat under the optimum level, and hence it may be difficult to precisely identify the optimum level. The financial manager must be satisfied if the total or if the level of current assets is in a range close to the optimal point. On the basis of concept, the working capital can be classified as gross working capital and net working capital, as we had discussed earlier. Gross working capital is the total of all current assets. The net working capital, on the other hand, is the difference between current assets and current liabilities. In the management of working capital, there are two characteristics of current assets that must be borne in mind. First is the short lifespan, and second, the swift transformation into other asset forms. Working capital is important in the policy decision, as we had discussed earlier, as it is concerned with the level of investment in current assets. To estimate the cash requirement of working capital, we may have to follow two-step procedure. First is to estimate the cash cost of various current assets required by the firm. Second is to deduct the spontaneous current liabilities from the cash cost of current assets. The various factors or determinants of working capital include the nature of companies, demand of creditors, cash requirements, nature and size of the business, time, volume of sales, terms of purchases and sales, business cycle, production cycle, etc. These form the type of working capital we have to conceive for a business. The operating cycle of a firm begins with the acquisition of raw materials and ends with the collection of receivables. It may be divided into 4 stages: raw materials and stores stage, work in process stage, finished goods inventory stage, and debtors collection stage. So, according to a maturity principle, the maturity of the source of finance should match the maturity of the assets being financed. This means that fixed assets and permanent current assets should be supported by long-term sources of finance, whereas fluctuating current assets must be supported by short-term sources of finance. We will now look into the different aspects of the estimation of working capital requirements, the concepts that are added to the current assets, and how the gross working capital is evaluated, and how the net working capital is attained. In this slide, you will be able to see the format of it. Firstly, we note down the current assets, and this current assets gives us the gross working capital. As we know, the gross working capital is the total of all current assets. The current assets involves minimum cash balances, the inventories, that can be raw material, work in progress, or finished goods, receivables, that includes debtors, bills, receivables, etc. So adding up or summing up all this current assets gives you gross working capital. After calculating the gross working capital, the next thing that we have to consider is the current liabilities, because to attain net working capital, we have to deduct the current liabilities from current assets, or the current liabilities from gross working capital. So current liabilities include creditors for purchases, creditors for wages, creditors for overheads, which gives us the sum or the totality of current liabilities, and the excess of current assets over current liabilities plus the safety margin that the firm considers gives us the net working capital. We will further inhale a better idea about current asset and current liabilities and the estimation of working capital requirement through few problems. So we'll discuss the first problem here. Here the problem says, prepare an estimate of working capital requirement from the following information of a trading concern. Projected annual sales 10,000 units, selling price rupees 10 per unit, percentage of net profit on sales 20%, average credit period allowed to customers 8 weeks, average credit period allowed by suppliers 4 weeks, average stock in terms of sales requirements 12 weeks, allow 10% for contingencies. So in this problem, the information regarding trading concern is given here. First, they have pointed out the projected annual sales of the firm, which is 10,000 units, which is that is an annual sale of 10,000 units is likely to take in place, and the selling price of 1 unit is rupees 10, and they have also marked net profit on the sales of 20%, and they have said that they allow their customers to take credit of 8 weeks, whereas their suppliers allow them a 4 weeks credit period, and there is an average stock holding for sales requirements of 12 weeks, and the firm keeps 10% for contingencies. Here we are supposed to estimate the working capital required as per the question. So we know the format of the working capital requirement statement, and here the first thing is that we have to find out the gross working capital or the total current asset, and from that we deduct the current liabilities, finally adding up the safety margin, we get the working capital required or net working capital. So here in this question we have two items on the current assets side, that is the debtors, that is the customers are provided with the product with the time for their payment at 8 weeks time, and we have to find out these values on the debtors values on the cost. So to find out the cost of the product or cost of the good, we know that the sales is done with 10,000 units, and we have the selling price of rupees 10 per unit. We get the total sales value as 10,000 multiplied by rupees 10, which gives you 1 lakh. From that we have to deduct the profit. The sales value includes the profit. So after deducting the profit, we get the cost. So cost is 20% of the sales value, which gives you rupees 20,000. So 1 lakh minus 20,000, you get 80,000 rupees, which is the cost of the good. So calculating the working capital required, the debtors, we have 80,000, which is the cost of the good, divided by 52, which is the number of weeks in a year, multiplied by 8. 8 is the time span that we have provided for our customers. So you get a value of debtors value as rupees 12,307. Similarly, in case of stock, we are keeping hold of the stock for 12 weeks. So 80,000 is the cost of the good, divided by 52 weeks multiplied by 12 weeks, which is the time period that we are keeping hold of the stock, which finally gives us 18,463. We have only these two components as current assets in the problem. So we sum up the current assets, which gives us the gross working capital or the total current assets of rupees 30,770. From this, we have to deduct the current liabilities. We have a current liabilities as only one component, that is credits or creditors. Creditors are our suppliers. They have given us a time span of 4 weeks to make the payment. So 80,000 is the cost of goods, divided by similarly by 52 weeks multiplied by 4 weeks, that is the credit period, which gives us rupees 6,152. As this is the only current liability we have in the question, we deduct this current liability from the gross working capital, that is 30,770, and we receive net value of 24,616. To this we have to add any safety margin that we have kept aside. So in the question it says 10% is kept aside for current contingencies. So 10% of 24,616, you receive 2,463. So the final working capital required, or the net working capital required, is 24,616 plus 2,463, which receives or gives us 27,078, which is the working capital required. Now here is a working of how we found out the cost of sales. Sales we know is we have 10,000 units for sale. Multiply the selling price per unit is rupees 10, which gives us 1 lakh. We know the profit is 20% of the sales value, which is rupees 1 lakh, which gives us finally rupees 20,000. And the cost of the sales is rupees 1 lakh minus 20,000, which gives us rupees 80,000. As it is a trading concern, cost of sale is assumed to be the purchases, and we value the working capital on the basis of the cost. So here cost of sales is considered. Taking up a similar problem, the Board of Directors of Rajesh Mills Limited request you to prepare a statement showing the working capital requirements for a level of activity of 30,000 units of output for the year. The cost structure for the company's product for the above mentioned activity level is given below. Raw materials cost per unit is 20 rupees, direct labor rupees 5, overheads rupees 15, the total of rupees 40, and from that the profit is rupees 10 per unit, which gives us finally the selling price of rupees 50. Now in this question, this is another form of formatting the question. Here the question has asked us to prepare a working capital statement, the estimation of working capital for a level of activity of 30 units. That is 30 units is the output for 1 year for the mills, and here is the cost structure of the company that is provided for a product, that is its raw material, labor and overhead is provided, giving us the total cost, and to this the profit is added, and finally which gives us a selling price per unit. Further, the question says past experience indicates that raw materials are held in stock on an average for 2 months. Work in progress, that is 100% complete in regards to materials and 50% for labor and overheads, will be half a month's production. And finished goods are in stock on an average for 1 month. Credit allowed to suppliers is 1 month. Credit allowed to debtors is 2 months. A minimum cash balance of rupees 25,000 is expected to be maintained. Prepare a statement of working capital requirement. So further, the question says us, or there are some adjustments in the question, which says that firstly, the past experience about the production gives us that the raw materials are held in stock on an average for 2 months, and the work in progress, that is which the 100% of the raw materials and 50% for labor and overheads is will be half a month's production. So in a half a month, 100% complete in raw materials and 50% of labor and overhead is considered to be the work in progress of half a month's production, and the finished goods are kept in stock for 1 month, and the suppliers gives us the goods on credit for 1 month, and we allow our customers to have 2 months credit for the sale units, and moreover a safety margin of rupees 25,000 is to be maintained. These are the different adjustments that we have to do in this question, and we are supposed to prepare a statement of working capital requirement. Analyzing the question, first we'll see what is the output per annum. The question says 30,000 units are outlaid, or there is a output of 30,000 units for 1 year, and we know that there is Stating the working capital required, firstly, we have to sum up or find out the gross working capital or the total of current assets. Then we have to deduct the current liabilities, and we have to add up the safety margin. Finally, we receive working capital required. So talking about the current assets, the first item is the stock of raw material. Here we know the stock of raw material is kept for 2 months. So as calculated earlier, the rupees 50,000 multiplied by 2, you get 1 lakh rupees. Similarly, work in progress is kept half a month, and we know that the raw material is fully utilized in that, fully taken up for, and it is 100% completely taken up. In other words, you give 50 rupees multiplied by half, you get 25,000 rupees, and labor and overhead is only 50% considered for a half month value. So it is 12,000 rupees multiplied by 1 by 2 into 50%, you get rupees 3,125, and overheads rupees 37,500 multiplied by again 1 by 2, as only half is considered for a month's completion, and multiplied by 50%, which gives you rupees 9,375, totaling of 37,500 as the cost. Similarly, the stock of finished goods is for 1 month, and the value of the good is rupees 1 lakh multiplied by 1, you get rupees 1 lakh. Similarly, debtors, the value of the debtor is 1 lakh, and it's for 2 months period, which gives you, that is, the customers are provided with the good for 2 months, so you get a value of rupees 2 lakh. Finally, summing up the gross working capital of the total current asset as 4,37,500. Now, talking of the current liabilities, we have only one component, creditors, which is that is, we are provided with the supply of the good for 1 month credit. So we take rupees 50,000 multiplied by 1. The supply here is the raw material, so rupees 50,000 is the value of the raw material multiplied by 1 month, we get rupees 50,000. We deduct that and get the value which is adjusted, or which is added, with which the safety margin is added. Here we are supposed to keep a cash balance of rupees 25,000, and finally we end up with working capital required as 4,12,500. Talking about the next problem, JBC Limited sells goods on a gross profit of 25%. Depreciation is considered as a part of the cost of production. The following are the annual figures given to you. Sales, 2 months credit, rupees 18 lakh. Materials consumed, 1 month credit, which is rupees 4,50,000. Wages paid, 1 month lag in payment, rupees 3,60,000. Cash manufacturing expenses, 1 month lag in payment, rupees 4,80,000. Administrative expense, 1 month lag in payment, rupees 1,20,000. Sales promotion expenses paid quarterly in advance, rupees 60,000. So here the question gives us various components, and have also provided in terms of their sales, the material consumed, and the gross profit, how much it is considered. And one more better item is there, depreciation, which is considered as a cost of production. The company keeps on 1 month stock each of raw materials and finished goods. It also keeps rupees 1 lakh in cash. You are required to estimate the working capital requirement of the company on cash cost basis, assuming 15% safety margin. So here the company says, or the problem says us that there's 1 month stock of each raw material and finished goods, and there's a safety margin of rupees 1 lakh as cash, and the company estimates the working capital with 15% margin, safety margin, and you are required to estimate the working capital on cost basis. So this problem is similar to the other two problems that we had discussed. Here also we have to find out the total current assets. From that we have to deduct the current liabilities and add up the safety margin. Finally we receive at the working capital required. So stating the working capital requirement, find out, we first hold on the current assets. The first item is a cash in hand, rupees 1 lakh, which is already given in the question. Debtors, that is, we provide our customers with the product of 2 months credit. So we have to calculate the cost of sales, as the working capital requirement is valued on cost basis. So cost of sales, we know that sales value deducted by profit margin, which is 25%, we get the cost of sales, which is rupees 14,70,000, multiplied by 2 months credit divided by 12 months, which is for 1 year, and we get a value of rupees 2,45,000. Similarly, prepaid sales promotion expenses, which is given in the question, rupees 15,000. Talking about the inventories, we have raw materials and finished goods as inventories, and they have said that it's kept for 1 month stock. So 4,50,000 divided by 12 gives you 1 month stock, 1 month's value. So it is rupees 37,500. Similarly, finished goods, 1,07,500, giving us a total of current assets. These are the items of the current assets, and the total of current assets summing up gives us rupees 5,05,000. Talking about the current liabilities, sundry creditors, which is valued at rupees 4,50,000. We have to get the value for 1 month. It is divided by 12. You get 37,500, and the outstanding manufacturing expenses, administrative expenses, and wages. Similarly, you have to value based on 1 month cost, and it is rupees 40,000, rupees 10,000, and rupees 30,000 respectively. And the totality of current liabilities is rupees 1,17,500. Now the excess of current assets, current liabilities minus current assets, we get 3,87,500. To that you have to add the safety margin, that is 15% is kept as contingency. You get which is 558,125, giving us a total of working capital required as 4,45,625. Now this is similar to the problems that we have done earlier, but here we are lotting out the cost based on 1 month, as the credit is given based on 1 month. So we value the working capital required is on 1 month credit. Now, taking a deeper look into the working notes, we are valuing the cost structure. Sales is already given in the question, 18 lakh. Gross profit 25% on sales, you get 4,50,000. Cost of production 13,50,000. And next to this cost of production, we have cost of materials 4,50,000, wages 3,60,000, giving us a total of rupees 8,10,000. And we add them up, receiving the manufacturing expenses as total of 5,40,000, and to this we add the cash manufacturing expenses, which is 4,00,000, 80,000. From deducting this cash manufacturing expenses from the total manufacturing expenses, we get the depreciation of 60,000. This is how we value the depreciation and how we evaluate the total of manufacturing expenses or the totality on cash basis. Further, the total cash cost is cost of production less depreciation. Add administrative expenses, add sales promotion expenses, you get total cash cost. So as the questioners have asked us to maintain the working capital required on cash basis, we are deducting the depreciation out of it and finally refining with the total cash cost. So cost of production, we know it is rupees 13,50,000 less depreciation, rupees 60,000. Add administrative expenses 1,20,000, sales promotion expenses 60,000. In the question, we have taken sales promotion as 15,000 because 60,000 is a quarterly expense, and we divide it to receive 1 month value for sales promotion expense. I hope the concept of working capital management is clear here. After establishing the level of current assets, the firm must determine how these should be financed, what mix of long-term capital and short-term debt should the firm employ to support its current assets, and hence how the total assets and of course hence the capital requirement change over time for a growing firm is depicted here. For the sake of simplicity, assets are divided into two classes, that is fixed assets and current assets. Fixed assets are assumed to grow at a constant rate, which reflects the secular growth of sales, and current assets are expected to display the same long-term rate of growth. However, they exhibit substantial variation around the trend line and the seasonal valuing patterns in sales and purchases. So the value of working capital in finance is of high importance and significantly a growing concept. Thank you. Module 2, Working Capital Cycle. The investment in working capital is influenced by 4 key events in the production and sales cycle of the firm. That is, purchase of raw materials, payment for raw materials, sale of finished goods, and collection of cash for sales. The firm begins with the purchase of raw materials, which are paid for after a delay, which represents the accounts payable period. The firm converts the raw materials into finished goods and then sells the same. The time lag between the purchase of raw materials and the sale of the finished goods is the inventory period. Customers pay their bills some time after the sales. The period that lapses between the date of sales and the date of collection of receivables is the accounts payable period or the debt period. The time that elapses between the purchase of raw materials and the collection of cash for sales is referred to as operating cycle, whereas the time length between the payment for the raw material purchases and the collection of cash for sales is referred to as cash cycle. The operating cycle is the sum of the inventory period and the accounts receivable period, whereas the cash cycle is equal to the operating cycle less the account payable period. The theory of working capital management describes how working capital should be managed and demonstrates the benefits in terms of liquidity, solvency, efficiency, profitability, and shareholder wealth maximization, which accrue to the company from appropriately managing working capital. Liquidity is affected by cash, credit, inventory, and accounts payable that form part of the overall cash flow of a business. A business that considers decreasing its levels of cash by carrying too many inventories or providing too much credit endangers its liquidity. From the perspective of the efficiency, the business that demonstrates the least working capital per rupee of sales can be considered as managing their working capital efficiently. To satisfy the requirement of efficiency, working capital management seeks to ensure that the investment in working capital component is neither too little nor too great. Generally, the higher the risk, the higher the return will be demanded by management and shareholders in order to finance any investment in working capital. Reducing the amount of working capital or fixed assets required by reducing the amount of cash tied up in accounts receivable and inventory while running the business contributes to improving the business performance especially the business internal performance, encapsulated in increase of EVA, economic value added, and of course shareholder wealth maximization. The investment in working capital and financing of working capital may subscribe to strategies which include a moderate approach, an aggressive approach, and a conservative approach. By management streamlining and bringing cash out of the operating or working capital cycle, profitability increases, the need for external financing is reduced, and a cash crunch that may result in liquidity and eventual bankruptcy is precluded. An aggressive investment approach, which entails the management of smaller holdings of cash, marketable securities, and inventories, should provide a better performance by way of a higher rate of return, but it is more risky than the moderate and relaxed strategies because these latter approaches maintain larger holdings of inventory, debtors, cash, and marketable securities. The cash conversion cycle assesses working capital in terms of cash outflows and cash inflows by focusing on both the level and composition of working capital. In terms of cash conversion cycle, the aggressive investment strategy would mean that accounts payable would be increased and investment in inventory and accounts receivable decreased. This should lead to a reduced in the cash conversion cycle. In contrast, a conservative investment approach to working capital management would result in an increase in the cash conversion cycle as accounts receivable and inventory increases and the accounts payable decreases. There are basically three approaches to financing working capital. These approaches are the hedging approach, conservative approach, and aggressive approach. Hedging approach refers to or it is also known as matching approach. Under this approach, the funds for acquiring fixed asset and permanent current should be acquired with long-term funds, and for temporary working capital, short-term funds should be used. In case of conservative approach, this approach suggests that in addition to fixed assets and permanent current assets, even a part of variable current assets should be financed from long-term sources. The short-term sources are used only to meet the peak seasonal requirements. During the off-season, the surplus fund is kept invested in marketable securities. Surplus current asset enable the firm to absorb sudden variation in sales, production plans, and procurement time without disrupting production plans. Additionally, the higher liquidity level reduces the risk of insolvency returns, and but lower risk translates into lower returns. Large investment in current asset lead to
higher interest and carrying cost and encouragement for efficiency. But conservative policy will enable the firm to absorb day-to-day risk. It assures continuous flow of operation and eliminates worry about recurring obligation. Under this strategy, long-term financing covers more than the total requirement of capital. The excess cash is invested in short-term marketable securities, and in need, these securities are sold off in the market to meet the urgent requirement of working capital. In case of aggressive approach, it depends more on short-term funds. More short-term funds are used particularly for variable current assets and a part of even permanent current assets. The funds are raised from short-term sources. Under this approach, current assets are maintained just to meet the current liabilities without keeping cushions for the variation in working capital needs. The company's working capital is financed by a long-term source of capital, and seasonal variation are met through short-term borrowing. Adoption of this strategy will minimize the investment in net working capital, and ultimately it lowers the cost financing working capital needs. The main drawback of this strategy is that it necessitates frequent financing and also increase as the firm is variable to sudden shocks. Risk preferences of management shall decide the approach to be adopted. The risk neutral will adopt the hedging approach, the risk adverse will adopt the conservative approach, and the risk averse will adopt the conservative approach, and the risk seekers will adopt the aggressive approach. Sources of working capital can be spontaneous, short-term, and long-term. Spontaneous working capital includes mainly trade credit such as the sundry creditor, bills payable, and notes payable. Short-term sources are tax provisions, dividend provisions, bank overdraft, cash credit, trade deposits, public deposits, bills discounting, short-term loans, intercorporate loans, and commercial paper. Long-term sources are retained profits, provision for depreciation, share capital, long-term loans, and debentures. To sum up, working capital cycle refers to the time taken by an organization to convert its net current assets and current liabilities into cash. It reflects the ability and efficiency of the organization to manage its short-term liquidity position. In other words, the working capital cycle is the time duration between buying goods to manufacture products and generation of cash revenue on selling the products. The shorter the working capital cycle, the faster the company is able to free up its cash stuck in working capital. If the working capital cycle is too long, then the capital gets locked in the operation cycle without earning any returns. Therefore, a business tries to shorten the working capital cycles to improve the short-term liquidity condition and increase their business efficiency. I hope the concept of working capital cycle is clear by now. Thank you. Module 3, Cash Management. Cash, the most liquid asset, is of vital importance to the daily operations of business firms. While the proportion of corporate assets held in the form of cash is very small, often between 1 and 4%, its efficient management is crucial to the solvency of the business because, in a very important sense, cash is the focal point of fund flows in a business. In view of the importance, it is generally referred to as the lifeblood of a business enterprise. Why does a firm need cash? There are 3 possible motives for holding cash: transaction motive, precautionary motive, and speculative motive. Transaction motive refers to when the firm needs cash to meet their transaction needs. The collection of cash, that is from sale of goods and services, sale of assets, and additional financing, is not perfectly synchronized with the disbursement of cash, that is for purchase of goods and services, acquisition of capital assets, and meeting other obligations. Some cash balance is required as a buffer. In case of precautionary motive, there may be some uncertainty about the magnitude and timing of cash inflows from sale of goods and services, sale of assets, and issuance of securities. Likewise, there may be uncertainty about cash outflows on account of purchases and other obligations. To protect itself against such uncertainties, a firm may require some cash balance. Speculative motive. Firms would like to tap profit-making opportunities arising from calculations or fluctuations in commodity prices, security prices, interest rates, and foreign exchange rates. A cash-rich firm is better prepared to exploit such bargains, and however, for most firms, their reserve borrowing capacity and marketable securities would suffice to meet their speculative needs. Cash budgeting or short-term cash forecasting is the principal tool of cash management. Cash budgets routinely prepared by business firms are helpful in estimating cash requirements, planning short-term financing, scheduling payments in connection with capital expenditure projects, planning purchases of materials, developing credit policies, and checking the accuracy of long-term forecasts. Firms use multiple short-term forecasts of varying length and detail suited to meet different needs. The commonly used designs for short-term cash forecasts are 1 year divided into quarters or months, 1 quarter divided into months, 1 month divided into weeks. A firm hard-pressed with liquidity crunch may even prepare a weekly cash forecast divided into days. The point to be emphasized here is that these multiple formats serve differing purposes and should not be regarded as mutually exclusive. The principal method of short-term cash forecasting is the receipts and payments method. Sometimes the adjusted net income method is used, though this method is employed mainly for long-term cash forecasting. Expressed as it is in numbers, the cash budget often conveys a picture of precision. Hence, a great deal of faith is usually put on. A moment's reflection, however, would reveal that the figures found in the cash budget merely represent estimates of future cash flows. The actual cash flow are likely to deviate from the estimates provided in the cash budget. The extent of deviation depends mainly on how volatile are the cash flows of the business. Given the uncertainties characterizing business operations, estimating the cash flows on the basis of a single set of assumptions, as is done in conventional cash budgeting, often results in an inadequate perspective on the future. Hence, it is advisable to prepare additional cash budgets based on different sets of assumptions. The least that a firm may do is to look at the cash forecast under 3 possible scenarios: pessimistic scenario, normal scenario, and optimistic scenario. Such an analysis provides a better perspective on future cash flows and facilitates the formulation of contingency plans. The cash budget of the firm indicates periods when the firm is expected to have shortage of funds and surplus of funds. If a shortage is expected, ways and means of overcoming the shortage must be explored. On the other hand, if a surplus is projected, it has to determine how it should be split between marketable securities and cash holdings. Several cash management models are addressed for the issue of split between marketable securities and cash holding. The very common addressed cash management models are the Baumol model and the Miller and Orr model. William J. Baumol proposed a model which applies the economic order quantity concept commonly used in inventory management to determine the cash conversion size, which in turn influences the average cash holding of the firm. The purpose of such an analysis is to balance the income foregone when the firm holds cash balances, rather than invest in marketable securities against the transaction cost incurred when marketable securities are converted into cash. The assumptions of the model include the cost per transaction is constant regardless of the size of transaction, the requirement of cash is distributed evenly throughout the period, and the requirement of cash for a given period is known, and there are two distinguishable costs associated with cash holding, that is opportunity cost and transaction cost. Expanding on the Baumol model, Miller and Orr consider a stochastic generating process for the periodic changes in cash balance. As against the completely deterministic assumptions of the Baumol model, Miller and Orr assumes that the changes in cash balances over a given period are random in size as well as direction. As the number of period increases, the cash balances changes form a normal distribution. Baranek hypothesized that firms where the cash inflows were steady but the outflows were periodic. This is mirror image of the time pattern of cash flows within the Baumol model, where inflows were periodic and outflows were steady. The challenge is to profitably invest the funds between the time of the receipt and the time when a group of checks are presented to the bank for payments. The Stone model is somewhat similar to the Miller-Orr model insofar as it uses control limits. However, it incorporates a look-ahead forecast of cash flows when an upper or lower limit is hit to take into account the possibility that the surplus or deficit of cash may naturally correct itself. If the upper control limit is reached, but is to be followed by cash outflow days, that would bring the cash balance down to an acceptable level, then nothing is done. If instead the surplus cash would substantially remain that way, then cash is withdrawn to get the cash balance to a predetermined return point. The main objective of cash management is an optimal cash balance, minimizing the sum of fixed cost of transactions and the opportunity cost of holding cash balance. Optimal balance here means a position when the cash balance amount is on the most ideal proportion, so that the company has the ability to invest the excess cash for a return and at the same time have sufficient liquidity for future needs. The minimum cash to hold is the greater of compensating balances, precautionary balances, and the company needs sufficient cash to satisfy daily requirements. Determining the optimal cash balance is one among the most crucial tasks in cash management area. To conclude, to enhance the efficiency of cash management, collections and disbursement must be properly monitored. In this context, the following are much helpful, that is prompt billing, expeditious collection of checks, control of payables, and playing the float. Various options are available for investing surplus funds available for short periods. The major options are fixed deposits with banks and money market mutual fund schemes. The principal method of short-term forecasting is the receipt and payment method. The cash budget prepared under this method shows the timing and magnitude of expected cash receipts and payments over the forecasted period, irrespective of how they are classified in accounting. I hope the concept of cash management is clear. Thank you. Module 4, Receivables Management. Receivables management is the process of making decisions relating to investment in trade debtors. If you want to increase sales turnover and profits of the firm, you have to sell goods on credit basis, which includes the risk of bad debts. The objective of receivable management is to promote sales and profits until that point is reached where the return on investment in further funding of receivables is less than the cost of funds raised to finance that additional credit. Receivables represent amounts owed to the firm as a result of sale of goods or service in the ordinary course of business. These are claims of the firm against its customers and form part of its current assets. Receivables are also known as account receivables, trade receivables, or book debts. The receivables are carried for the customers. The period of credit and extent of receivables depends upon the credit policy followed by the firm. The purpose of maintaining or investing in receivables is to meet competitors and to increase the sales and profits. The receivable management is the process of managing the account receivables within a business organization. Account receivables simply means credit extended by the company to its customers and are treated as liquid assets. It involves taking decisions regarding the investment to be made in trade debtors by organizations, deciding the proper amount be lent by the company to its customers in the form of credit sales is quite important. It affects the overall cash availability for undertaking various operations. The objectives of receivables management include monitor and improve cash flow, minimize bad debt losses, avoid invoice disputes, boost up sales volume, improve customer satisfaction, helps in financing competition. In facing the competition. And the factors that influence the size of receivables are the size of credit sales, credit policies, terms of trade, expansion of plans, relation with profits, credit collection efforts, habits of the customers. And for forecasting the receivables, credit period is allowed, the credit period allowed, the effect of cost of goods, and the forecasting expenses are involved. The important dimensions of a firm's credit policies include credit standards, credit period, cash discount, collection effort. These variables are related and have a bearing on the level of sales, the bad debt losses, discounts taken by customers, and collection expenses. Credit standards there is a pivotal question in the credit policy of a firm, that is, what standard should be applied in accepting or rejecting an account for credit granting. A firm has a wider range of choice in this respect. At one end of the spectrum, it may decide not to extend credit to any customer, however strong his credit rating may be. At the other end, it may decide to grant credit to all customers irrespective of their credit rating. Between these two extreme positions lie several possibilities, often the more practical ones. And credit period, on the other hand, refers to the length of time customers are allowed to pay for their purchases. It generally varies from 15 days to 60 days. When a firm does not extend any credit, the credit period would obviously be 0. If a firm allows 30 days, say, of credit with no discount to induce early payments, its credit terms are stated at net 30. Cash discount, if the firms generally offer cash discounts to induce customers to make prompt payments. The percentage discount and the period during which it is available are reflected in the credit terms. For example, credit terms of 2/10 net 30 means that a discount of 2% is offered if the payment is made by the 10th day. Otherwise, the full payment is due on the 30th day. And finally, collection effort. The collection program of the firm aimed at timely collection of receivables may consist of monitoring the state of receivables, dispatch of letters to customers whose due is approaching, email and telephonic advice to customers around the due date, threat of legal action to overdue accounts, legal action against overdue accounts. A rigorous collection program tends to decrease sales, shorten the average collection period, reduce bad debt percentage, and increase the collection expense. A tax collection program on the other hand, would push sales up, lengthen the average collection period, increase the bad debts percentage, and perhaps reduce the collection expense. Proper assessment of credits is important as it helps in establishing credit limits. In assessing credit risk, two types of errors occur. Type 1 error is a good customer is misclassified as a poor credit risk. Type 2 error is a bad customer is misclassified as a good credit risk. Both the errors are costly. Type 1 error leads to loss of profit on sales to good customers who are denied credit. Type 2 error results in bad debt losses on credit sales made to risky customers. While misclassification errors cannot be eliminated wholly, a firm can mitigate their occurrence by doing proper credit evaluation. Three broad approaches are used for credit evaluation: traditional credit analysis, numerical credit scoring, and discriminant analysis. The traditional credit analysis calls for assessing a prospective customer in terms of 5 C's of credit. Character, that is the willingness of the customer to honor his obligations. Capacity, the ability of the customer to meet credit obligations from the operating cash flows. Capital, the financial reserves of the customer. Collateral, the security offered by the customer in the form of pledged assets. Conditions, the general economic conditions that affect the customer. The numerical credit scoring, on the other hand, unlike in traditional credit analysis, customers are assigned to various risk classes, somewhat judgmentally on the basis of 5 C's of credit. While in credit analysts may however want to use a more systematic numerical credit scoring. Such system may involve the steps like identifying factors relevant for credit evaluation, assigning weights to these factors that reflect their relative importance, rate the customer on various factors. For each factor, multiply the factor rating with the factor weight to get the factor score. Add all the factor scores to get the overall customer rating index, and based on this rating index, the customers can be classified. And finally, the discriminant analysis, the credit index described in case of the second category, that is the scoring, numerical scoring analysis, is somewhat in nature and is based on weights which are subjective in nature. Can a better credit index be constructed? Yes. The technique of discriminant analysis may be employed to construct a better risk index. The nature of this analysis may be discussed with the help of a simple example, that is ABC company manufactures products for industrial customers. It considers the ratios on the basis of determinants of creditworthiness of its customers, that is current ratio and net worth ratio. And based on this, if we plot a graph and we find the variables, and finally we sense out the overall score, the stronger and the weaker scores of within the ratings of the credit rating, and the score is known as Z score. So if the higher the Z score, the stronger the credit rating, and lower the Z score, the credit rating is low. And Z function with two variables, and these two variables depends upon the classification or the examples that we encounter. To conclude, receivable management business ensures that a sufficient amount of cash is always maintained within the business so that the operations can continue uninterrupted. It helps in deciding the optimum proportion of credit sales. The overall process of receivable management involves properly recording all credit sales invoices, sending notes on the date to collection department, recording all collection, calculation of outstanding interest on late payment, etc. Receivable management aims at raising the sales volume and profit of the business by managing and providing credit facilities to customers. A proper receivables management process aims at monitoring and avoidance of occurrence of any overdue payment and non-payment. It is an effective way of improving the financial and liquidity position of the company. Credit facilities are important for attracting and retaining customers, and this makes management of credit facilities by business crucial. I hope the concept is clear. Thank you. Module 5, Inventory Management. There are three types of inventories: raw materials, work in process, and finished goods. Raw materials are materials and components that are inputs in making the final product. Work in process, also called stock in process, refers to goods in the intermediate stages of production. Finished goods consist of final products that are ready for sale. While manufacturing firms generally hold all the three types of inventories, distribution firms hold mostly finished goods. Inventories